Moneyweb now. On the money.
This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions. I'm chatting with Sello Seleke. He's from Absa CIB. Sello, appreciate the time. The seasonally adjusted Absa Purchasing Managers Index, PMI data out. We got 46.8 in July. That's down from 47.3. But in the release, accompanying the numbers, the concept perhaps not an overstating weakness in the underlying manufacturing condition. Talk me through the fact that this number might not be as bad as it seems on the surface.
Yeah, thanks for having me. So I want to say that this PMI release is quite interesting. So a decline this time around hides more positive things than it reveals. So firstly, the PMI declined because of inventories as well as supply delivery times. So for supply delivery times, the decline is quite welcome this time around.
Yeah.
And we think that the decline is showing us that supply chain disruptions are easing, because recently we've seen a situation where supply delivery times are increasing even when activity is weakening. So that's a positive. And then two other positive things to highlight is that new sales orders improved, and they improved at the back of domestic demand. And we also saw, as a result of demand improving, the business activity index also improving. So I think all in all, the underlying data of the PMI is quite positive. Also, if you take into account how the purchasing price index eased in July.
And you make the point around inventories and it declined, but you also say in the press release, it could be delaying purchases in anticipation of lower input costs. In other words, this is actually not around demand. This is just like, hey, it might be cheaper in a week or a month.
Yeah, so we think that it can be that, or it can be as a result of manufacturers not being convinced that this strong demand story, especially on the domestic side, might be sustained.
I get you. And we're simply not sure, but we'll get, as we move on through the year. What we did see, very encouraging, purchasing price index coming down in July. This kind of suggests that the oil price shock and fuel price shocks have largely moved through the system. We are not back where we were in February, but the worst is definitely behind us. And the data here confirms that.
I think so too. I think that's how manufacturers are interpreting it. Because if you look at, the Brent crude oil price on a month-to-month basis, it didn't really move much. So I think, they just think that the West is past us, and hopefully the West is past us. But as you did say, in level terms, costs are nowhere near where we were pre the war period. But something to keep an eye on is the recent weakness in the rand. So if that continues, we might start to see this purchasing price index going forward start to rise again.
Gotcha. Yeah, of course. Employment, the one I always turn to, it ticked up from 41.4 to 42.2, still well off May. Employment, more broadly for our economy, employment remains a challenge, and this month's PMI kind of confirms that.
Yeah, it's quite encouraging to see the employment index tick up a bit, but it has ticked up to levels that are way below what we saw in May. And in fact, this index has been below 50 for some time, right?
Yeah.
Which suggests that employment in the sector has been quite subdued. So what will turn this employment index upwards? It will be, sustained activity in the sector that will hopefully lead to more employment in the sector.
Yeah, and if I look at that, particularly the employment, maybe 10 times in the last decade, it's been above 50. It's been a continual. Last question, and certainly a piece of good news, is that the data is suggesting activity in Durban Port is definitely picking up. And Durban Port was a huge concern, and certainly there is a turnaround happening. It's slow, but it certainly is happening, which is good for the economy.
Yeah, it's good because, our ports and our railway lines, or let me just say network industries in general, those have been a binding constraint on South Africa, right? So as that improves, then we will start to see the SA economy moving past the 1%, I will say, barrier for now, because it feels like it. So as soon as our logistics sector gets better, that's when you'll start to see GDP improving quite a bit, provided that, structural reforms elsewhere are also progressing. But what I want to say is that we need to be cautiously optimistic because, yes, the Durban port is improving, but the Cape Town one seems to be lagging. When you look at anecdotal reports, for example, in newspapers, you'll see that some of the farmers, are diverting their exports from the Cape Town port to elsewhere. So that's one to keep an eye on. And this port, for some time, has been ranked very bad in terms of the World Bank rating. So, yes, optimism, but cautious optimism.
I get your point. And I mean, ports infrastructure is such a bottleneck that needs to be resolved. And then we can start looking at that 1% GDP. We'll leave it there. That's Sello Seleke. He's Absa CIB. Appreciate the time. This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions.